Intro. Yes. Welcome to Flywheel, your number one source for everything Frax, DeFi, and everything in between. If you want to know what's going on in the world on chain, well, you come to the right place. This is DeFi Dave, here with Capital K, and we are here to help you harness the power of the Flywheel and talk about people helping, harness the power of the AMM. We had on the fellas from Ambient. We had on Doug and we had on Miyu to talk about what they're building and what they just came out with. Kit, what are your thoughts on this one?
Well, first off, Ambient Finance, aka FrxETH, in case those have been around since earlier. You know that.
They'll always be honestly like the I will always remember FrxETH because I remember reading about it and how cool it was, and how cool it is. And everything that they've developed since.
Yeah, because I remember FrxETH was going to be built on Barachain. I was like, oh, maybe they're going with like a zoo theme, some kind of animal theme here with every one of their DeFi protocols. But yeah, I mean, Dave, I love Doug's background. This man comes from a very rich experience set, and now he's going to bring in all of that into DeFi. And obviously, Miyu is a great product designer. The UI is amazing on their product, which is Ambient Finance. But yeah, how about you, Dave? What should the listeners be paying attention to?
Speaking of rich, it's incredibly feature-rich, the product that they built, like all the different mechanisms they have, whether it's dynamic fees, whether it's knockout liquidity, and whether it's all this other stuff. So, but I think like the number one theme of this is, they're really trying to fight for the little guy. I came into this like, oh, this is a war on toxic flow. But coming out of this is like, oh, they're like the Robin Hood of AMMs. And so I was paying attention to that. What do you think?
No, I think you're spot on. Like you could just feel that underdog energy and that rebel that this team is trying to fight for the AMM space. And I'm going to use it. I'm going to drop it. This is a capital P primitive. Another one.
Capital P. Another
one. I'm calling it.
And if you want to see Kit judge if something's a capital P primitive every week, make sure you hit that bell button, subscribe, leave us a comment, let us know what you think. Give us a like. Make sure you follow us on Twitter at FlywheelDeFi. Make sure you join our Telegram group at FlywheelDeFi. You can follow me on Twitter at DeFiDave22.
You can follow me at 0xcapital_K.
And let's get the flywheel spinning. Do you hold ETH but don't know what to do with it? Want to earn those juicy liquid staking derivative yields but don't know where to start? Well, FrxETH is there for you. FrxETH is Frax's native LSD solution, allowing you to earn boosted yields in multiple ways on your ETH. If you want to get started, go to app.frax.finance and turn your ETH into FrxETH today. Welcome back, everyone, to this edition of Flywheel. I'm your host, DeFi Dave, here with Capital K, and today we have on the folks from Ambient Finance, formerly known as FrxETH. We have on Doug, who is the co-founder, and Miyu, who leads business development. Guys, thank you so much for joining us. We're really excited to have you on. We've been diving deep into your AMM, and we're excited to break it down for everyone.
Hey, awesome. Thanks for having us.
Yeah, thanks for having us. Really excited.
Yeah, so let's dive in a little bit on your guys' backgrounds. So what is your background before crypto, and how did you get into AMMs?
Yeah, I'll start. So before crypto, I was a HFT quant for a while, about a decade. Started at Citadel, doing equities, and then
the dark side.
The dark side, yeah, exactly. And then been on some number of smaller teams in various markets around the world, futures and equities. Kind of randomly got into MEV in 2020, right around DeFi summer. Just thought it was interesting. Kind of started as a side project and then took over full time. Did MEV for a while. So was interacting with AMMs a lot. And then kind of when Uni V3 came out or first announced, I thought it was a really interesting concept, but there were a number of ways to improve it. Then started FrxSwap and have been here since. Miyu, I'll let you go.
Yeah, Miyu, go ahead.
Yeah, my background's not as interesting as Doug's. Basically, before crypto and DeFi, I was doing more design-based things like architecture, building design. And then kind of post-COVID, late 2020, 2021, kind of got into trading and crypto and DeFi and just kind of AMMs was a really interesting part of that, just the microstructure of order flow and things like that. So it was great to start working with Doug.
Yeah, Doug, you said that you worked at Citadel, and I think I read somewhere that you worked there for 10 years. I'm really curious.
I only worked there a couple of years. I worked in HFT for 10 years.
Oh, you worked in HFT for 10 years and Citadel for a bit. So what lessons did you learn at your time at Citadel?
Yeah, a couple of things. I guess the biggest is just kind of these small things around really HFT, like a lot of people think it's synonymous with being a market maker or providing liquidity, but like in HFT, actually, quote unquote, taking liquidity is just as popular, if not more lucrative than providing liquidity. So I guess you really just learn. You don't really learn anything about stocks or futures from like a macro perspective, or even like what makes a company move day to day, but you do learn like what makes things move second to second. So like, for example, I traded Japanese equities. If anyone's familiar with that market, like the stock symbols are actually just numbers. I didn't really even know. I knew some of them, knew like what Toyota was, but most of the time when I was trading, I just know that's like 227 or whatever. So it's kind of weird, right? You don't learn anything about the actual things that you're trading, but you do learn, right, like how these mechanics work on a very low level, which I think is pretty important. And there are all these like tiny games at like a very, very low level. Like superficially, you think trading is just, Alice wants to buy at this price, Bob wants to sell at this price. And, right, we have a match and they should be able to buy or sell. In reality, right, like Alice and Bob have different information, right? And if Alice knew exactly what Bob knew, then she might want to trade or might not want to trade. So really, like at this very fine grain level, there's this dance between like who knows what and like how information gets incorporated into markets. So I think that's kind of the most fascinating thing.
And you said something there at the beginning of that. You said taking liquidity. It's not just providing liquidity but taking liquidity, which is a term I have not used before. So what did you mean by like taking liquidity? Yeah.
So typically like in an order book context, high frequency traders will be divided into like makers and takers. So makers are like market makers, like you would normally think, and most times they're willing to buy at some price and willing to sell at a slightly higher price, and they're hoping that just buy. They'll buy $55 and sell $55 1 cent, and you kind of make that spread. So superficially, that's like a easy business, right? As long as things work out for you. The other side of that though is takers, and they exist. They're not providing. And right, people can mix and match like parts of the strategy, but right, like at high level, like, and some people just do taking, like so some firms just basically only do taking, and all they do is they sit there and they watch the order book, and they're not placing any orders, they're not providing liquidity, their orders aren't resting, they're just waiting till they have internal signals, and like their signal is more aggressive than the price, and they say, okay, for a very common thing is like the index futures will trade in Chicago. The S&P 500 index futures, they're much more liquid than like any individual stock. So if you have a very fast connection to Chicago, from New York to Chicago, you wait till the index futures move up, and then you just go to like individual stocks and just buy them quickly before anyone can adjust their quotes. So takers are kind of like snipers, I guess.
Yeah, that's interesting because I've always thought of, market makers as making markets and providing liquidity. I've never really thought of market makers as being takers before, but if they have that edge, and like you were talking about with information asymmetry, then it makes sense that we're just takers in this field.
Yeah, and a lot of times, there's various research on this, but a lot of times, actually, if you dive into it, look at an aggregate level, takers are just as profitable, if not actually a lot more profitable than makers. So that's kind of a funny.
So, interesting.
You mentioned something about being, a faster. And when I think of HFT, the word flash boys just come to my mind right away. And how accurate is the reality versus what Michael Lewis painted?
Yeah, I'm not a huge fan of that book. It's pretty entertaining. It's a very entertaining book. I don't think it's hugely accurate. So I think the biggest misconception someone will get from reading that going away is that if they think someone can see your order kind of before it reaches the market, and that actually does happen with MEV and sandwich attacks, but generally in a TradFi market, that doesn't happen because the time your order reaches the gateway at the exchange, it's atomically matched, and people can kind of infer what you might do next, which is an issue if you're a big trader. But if you're a small trader, it's not really an issue. There's also with U.S. equities, there's multiple different exchanges. So I think there was a problem in the book, the heroes of the book or whatever, were not kind of slicing their orders correctly. So someone would see, they had an order at NASDAQ, and then inferring, you're probably going to take at NYSE or whatever. So I don't know, an entertaining book, but not. I wouldn't say it's the most accurate, at least from personal viewpoint.
Got it. Now, with that background, let's dive into Ambient, which was first announced as FrxETH in 2021. So for the viewers at home, can you describe, what Ambient is? And for those who remember when FrxETH was announced, I think everybody's wondering what took so long for it to come out?
Yeah. So I think, we had our original vision in 2021, which I think was a good vision, and we're still building on top of it. But I think what we realized, particularly as things went from the bull market to the bear market, was that kind of dethroning Uniswap would be a lot tougher than we originally imagined. So basically the version of Ambient that we have out now is basically, I'd say it's FrxSwap V2 from that perspective. So we just decided we had to kind of come out with something even. I think the first version we had was great, but it wasn't kind of good enough to dethrone the monopoly, and kind of what we saw as the bull market, you had all kinds of DEXs would start up and get a bunch of TVL, and then kind of in the bear market, those all went away. So if you actually look at the market now, Uniswaps of real organic trading, just and not counting stable coins, volatile pairs, just very, very high percentage. So yeah, I'd say there's two theses with what we have now and really what we focused on building from the original version of FrxSwap, or kind of at least building the platform so we can build these things. The first is, and Miyu can probably talk about this a lot more than I can. The first is we wanted to not only get the protocol right, but get the actual application right. And kind of we wanted to make sure that the application looked and felt and drove kind of a centralized exchange. We're not a big fan of most of the DeFi, particularly the DEXs out there don't really feel like something you'd spend a lot of time trading on. So Miyu's kind of the brain behind that. So Miyu, I don't know if you want to say anything from that perspective.
Yeah, I mean, you summed it up pretty well, but yeah, a lot of our focus over this past time has just been on improving the UX around, DEXs, and there's a lot of simplified swap interfaces, which function fine, the basic Uniswap module, swap this to this. But I think especially on the LP side, there was a lot of room to improve that process. And then more generally, just the entire process. So we kind of have, somewhat of a block explorer basically built into the deck, so you can sort of see your own transactions and others' transactions much easier. So
there's a block explorer in the DEX. That's really cool.
It's really cool. You can actually, so a lot of people were trying to get more education. But yeah, it's really cool. Like even on our candle chart, you can click any single candle and then see exactly like what transactions happened in that candle.
Oh,
so
that's really useful.
Cool little Easter eggs there. Yeah, not Easter eggs, features. Use them, but
yeah. What was interesting about last cycle, Uniswap was by far the most forked protocol. You saw SushiSwap come out with their vampire attack, and then with all these different chains, they each had their different flavor of Uniswap and UniV2. So like observing, like and like you said, Uniswap is the top dog. You didn't see a way to challenge Uniswap with V1 basically, so you basically waited until you were comfortable with V2 to come out. What do you think like makes Uniswap like have its top position? Like, why do you think there hasn't been like a challenger just yet?
Yeah, I think DEXs have gotten, well, AMMs have gotten a lot more. Even just V3 to V2 is a big complexity ramp up. I think V2 mechanics of that are fairly simple. So forking and even kind of doing other stuff, small modifications on top of V2 is not super technically challenging. V3, like concentrated liquidity, like we all know how concentrated liquidity works, but like the underlying math of like concentrated liquidity gets pretty hairy. And then like even beyond that, now with like what we have with our hooks or like Uniswap V4's hooks, I think things get even more complex, right? Because now you have like the DEX is not even just DEX becomes like a platform, like something you build on top of. So I think like things are just getting more complicated. So like the number of teams that can kind of do like kind of the minimum barrier to entry is higher. But also just in general, I think, right, like there hasn't been a lot of innovation in the mechanism. I think there's been a ton of innovation in DEX Ponzi-nomics, right? Like how do I build a DEX and then kind of have all kinds of creative ways to vampire tag or get tokens or whatever, which works really well in a bull market. But I don't think anyone is, people have played around, but I don't see any like huge sea changes in like how the actual mechanics of an AMM work. Like I don't think there's really anything out there besides us where the AMM itself is like a huge improvement over Uniswap. So like naturally kind of their position as the leader is just going to solidify if there's no like major 10x improvement over what they have.
Got it.
And actually, that leads kind of perfectly to my next question. Was like what makes Ambient so much better at solving the current problem kind of plaguing the AMM space than Uni or even Curve for that matter?
Yeah, for sure. So I think our big focus has been, like circling back a little to the question of like what we've been up to since 2021 is our big focus has been on like how do we make the economics of Alpine sustainable. And I'm sure everyone by now is aware of right, like Alpine isn't necessarily the most profitable endeavor. So what I think makes us different is the core platform. We have enough hooks. We have enough extensibility, modular. So not just hooks, but other things. Well, we have enough modularity where we can really innovate on this problem. And I think the big thing is there's really been very little innovation around like accurately pricing liquidity. So the model for AMMs up until now has been there's a pool, there's a fixed price in the pool, and even UniV3 you might have different fee tiers, but there's in a pool there's one fixed fee tier and it's fixed forever. So you're in the 5 basis point pool, you're in the 30 basis point pool. That's like when you think of fee tier is like the price of liquidity. It doesn't make any sense, right? Why is the price of liquidity the same from now until the end of the universe? For some, it just doesn't make any sense, right? So I think, right, like how you solve it is you accurately price liquidity. So we take two approaches to that. One is like a time-based model that will be rolling out pretty eminently, where we're looking at different periods and looking at, okay, what is like kind of the optimal, we have like a model where what's the optimal liquidity fee for a period. When liquidity is scarce, you should charge more, and liquidity is abundant and there's not much kind of volatility. Makes sense to charge less, right? To be more aggressive. And then even, right, we have like in our platform, we can even start building in systems where, and not just us, right? Anyone can, because we have our own idea of like how hooks work and how these things work. But like, and it will be extensible to the point where anyone can kind of build on top of this. But we think this is kind of like the right approach. Having thought of it for a while, we can start looking at, okay, where does order flow come from, and say, right, there's just, if you actually look at the data, there's a very small amount of wallets that are responsible for a huge amount, high percentage of the toxic order flow. So, obviously they're very clever getting around whatever you put in there, but like, right, there are certain credible commitments of non-toxicity that people can make. So like, for example, if order flow comes from the CowSwap router, that's very, very likely non-toxic, because if I'm a MEV shop and I'm trying to arbitrage the price of Binance, I'm not going to wait 30 seconds for the CowSwap solver to fill me, right? Another example, this is kind of dumb, but if order flow comes from the MetaMask router, that's also non-toxic, because you're paying that huge fee on top of it. So I wouldn't recommend using it, but the fact that like order flow is coming from that is like, right, from the perspective of liquidity, you want to be like more aggressive going after that, because it's not toxic. So I think like what really distinguishes us is both like in the platform itself, we've built in kind of this modularity to be, so we have our own version of hooks, but I think our version kind of is a little bit superior around this to kind of price liquidity accurately, and particularly around toxic flow discrimination, as well as like internally, like we've thought about how to build this stuff. And, I think one difference of our approach relative to Uniswap when V4 eventually comes out is I don't think they really have any intention of building this infrastructure themselves. They're going to farm it out to other people. I don't necessarily know why you would build that on something where they're kind of going to accrue all the value out of that, particularly because it's like a 4-year closed source or business library or whatever. But yeah, I mean, we intend to build this infrastructure as well. We might not build the best, but at least like we're going to build something. Yeah, we've thought about it for a while.
Yeah, honestly, listening to your past interviews, it sounds like you guys are really going to war with toxic flow. And I can't help but to notice this kind of Robin Hood feel that's around Ambient. Like you work in high frequency trading, you saw how everything worked on that end. And then you saw the power of AMMs, like, oh my God, the little guy, they can provide liquidity too. And like how the playing field was evened out. And then you saw like, wait a second, like all these different things are happening. Like how can how can the average Joe provide liquidity? So going back a bit, so what exactly is toxic flow? Like, what is your definition of toxic flow, and what is your plan to battle against it?
Sure. So, I mean, like, the toxic flow is really just the idea that there's order flow that is informed about has some sort of information that you don't have, right? So, like the simplest example would be like kind of dumb, but like, let's say you're in a bar and somebody comes up, let's say you're an above average pool player and somebody comes up and wants to bet you $1,000 to play pool and you don't know anything about it. Well, unconditionally, if I'm an above average pool player, I'd love to play pool against someone and bet. But right, the fact that the guy's coming up to me and betting to play pool, right, that probably means he's actually like a very, very good, he's a pool shark, right? So that's like kind of the core idea, is that even if you think it's good to trade at a certain price, the fact that somebody wants to trade against you at that price is kind of a signal that maybe they know something that you don't. So like insider trading would be example of like a very simple example of toxic flow, right? Like, why is someone selling like all these out of date, like all these far out of date like options, right? Like at a certain time, right? Maybe they know something that you don't know. Really, like, what happens is like most toxic flow in the market is just stuff that happens at a very, very high frequency. So most toxic flow is really just high frequency traders who are watching signals that change very quickly. And in this case, really, the reality is it's mostly Binance. So I would hope we eventually get to a point where all crypto price discovery happens somewhere other than Binance. But for the time being, price discovery happens at Binance for like every major crypto asset right now. So really what toxic flow practically looks like today is somebody sits there, watches the price at Binance, waits till the price at Binance moves, and then the price at the AMM is stale because Ethereum we have slow block times. But even if we didn't have slow block times, right, price at Binance moves, someone's going to be the first person to trade against it, and that person's just pumping money out of the system. And probably what they're really doing is they're paying most of those profits to Flashbots or the block builder, whoever, to get at the top of the block. So really it goes to the block builder and probably indirectly goes to validators. And it's good, actually, probably burns a lot of Ethereum if you hold a lot of ETH like me. Kind of happy about that, but not happy from an LP perspective, because those people are just straight up, like at the end of the day, you think about it, they're just straight up making a ton of money. And whose pocket does that come out of? That's the liquidity providers.
Yeah, it's funny. I was talking to a friend, I think a year ago, and it seems like LPs are not automated market makers; they're automated market takers, because they are like willing to buy or sell at any price, and they can't do anything about it.
Yeah, and I think that's actually so. I think like a lot of people tried to solve this by like having oracles that move the price around, which kind of comes with a couple of problems. The first is that someone could front run the Oracle update. But the second is you don't necessarily like need to move the price around. You just need to get paid enough for somebody to take it. And that kind of may seem like a silly distinction, but one problem when you start moving the price around in the AMM is it breaks like all the math around it. So like it's no longer like price independent. How things move, and like then you have to like rebalance, and like that it becomes like pretty messy to do. So like it's fine. Like that's the other thing, like a war on toxic flow. We don't necessarily want, like, we still want arbitrageurs, right? Like we still want the price to become in line. We just want liquidity providers to be paid fairly for it. So if somebody is just sitting there and watching the price at Binance move and send, whatever, right? Like they're probably, that's a useful service. It's just not whatever. It's just not worth 200 million or whatever, like the price was like in the past 3 months from the ETH USDC pool. Maybe that's a couple million, should be 200 million or like whatever.
And what are the long-term consequences of toxic flow when it goes unchecked? Because if I was to make the devil's argument, other than having toxic in the name, what's toxic about toxic flow? Hell, it's still volume to LPs. It's still they're still earning 1%.
Yeah, exactly. Yeah, I mean, so again, right? It's not. Well, there's two ways to think about it. Like one way to think about it is like if it's one way to think about it is like a casino, right? If you have card counters in the casino and most of the participants, like the casino has an edge in most games, but you have a subset of people who have an edge, or you have card counters and you don't throw them out of the casino, like eventually the casino stops making money. Not to say these are casinos, right? These are important markets, but right, like same concept, right? Like the house has an edge or the players have an edge. And if you don't check the players, like eventually the house no longer has an edge. And it's clearly, it doesn't help most players. If I'm not a card counter, card counters don't help me. In fact, it probably makes it worse because the casino is losing money and it's probably like not going to comp my drinks or whatever anymore. But, right, like, so it's bad from that perspective. But like you said, from an AMM actually specifically, like you really, every pool is making this trade-off between what's the IL in the pool and permanent loss and how much fees am I collecting? And really like IL is actually the interesting thing about it is it really doesn't have much to do with the activity in the pool. Like it just has to do with where the price, because of this nice math of AMMs, it just has to do with where the price ends. So like one way to think about it is you're going to get the same IL regardless. You just want to maximize fees at the end of the day. So one way to think about like toxic flow, and particularly like arbitrage flow, is you're still going to have arbitrage flow. Like arbitrage is still going to happen, but you just want to charge that flow as much as they can. So like the real problem isn't that toxic flow exists. The real problem is that toxic flow is not being charged enough relative to whoever it is.
I like that point. It's not that it exists that's a problem, because it's always going to exist. There'll always be these information asymmetries, but it's not being charged properly with the fees.
Exactly.
And that's where you have the dynamic fees come in.
Exactly. So like ideally, like the perfect scenario would be like you have an oracle and everybody like exactly says, oh, here's my edge on any given trade, and you charge them exactly what their edge is. That's obviously can't do that, but like that's like kind of the perfect system.
Yeah. And in like the TradFi world, with toxic flow, are there any remedies to it in the TradFi world? Like, have you seen anything in your previous work?
Yeah. I mean, the TradFi world is funny because right, you get so one reason like I really like AMMs relative to order books. A lot of people from like with TradFi background will just dismiss AMMs out of hand. I think that's wrong. But one reason that like AMMs are I really like them relative to order books is everyone kind of participates at the same rate. So if you're a liquidity provider, I'm a liquidity provider, we're all liquidity providers. We're not at war with each other. We're all in the same boat. And like concentrated liquidity, maybe there's some differences, but it's not huge actually, like if you look at it. So we're all in the same pool. We're all in the same boat. We're all participating. Like we all are wanna make it, right? If you're in an order book, like that no longer holds at all, right? Like if we're in an order book and we're market makers, we're at war with each other every single day. So like the biggest thing you see is in like market makers, what's really important is like getting quote unquote the front of the queue, which means like when I place my order is the first, like at a given price level is the first one to be executed, and it's the first in first out system. So that's like a big reason latency is like such a big deal, because like one reason. So like the first time like a price moves, like we're all going to be at war and like try to submit our bids as fast as possible so we can be the first person. And if you actually like look, there are multi-billion-dollar firms that do nothing. They have no other edge. Their edge is they're very fast and they can get at the front of the queue. So
So that's like Robinhood and Citadel, right?
Yeah. Well, yeah. And that's another, right? Like getting order flow. So like there's a lot of PvP games in order books that don't exist in AMMs. And like the unfortunate reality, like I think order books are good. And I think it's a lot better than like the floor system or things that came before. But like the unfortunate reality is like there are a ton of wasted resources that go not necessarily to making the market more efficient or transaction costs lower for end users, but just for like these PvP games that HFTs play against each other. And that's probably if you're going to start an HFT shop and you say, okay, Doug, how can I make money as I would tell you, just focus all your time on these PvP games.
Yeah. For me personally, my favorite thing about AMMs when I first discovered them in 2020 was the fact that any token could get listed. At my first job, I helped out and worked on getting our token listed on exchanges. And man, it was such a process and a nightmare trying to, fill out forms and then, going back and forth. And like, even if it gets listed, there's not enough liquidity. With AMMs, it's like, boom, just deploy your token. Boom, you have liquidity right there. You can run an incentive program for there to be liquidity after all. And Kit, I know you had a question about, the listing process and everything, or how they, go ahead.
Yeah, actually, I was going to get to that a bit after this one, because then in a previous pod, Doug, you had mentioned something like almost a gifting button, and then effectively, like it made me think of almost giving this user a toxicity score, right? It's almost like a credit score based on their history of how their flow is. It's like, how toxic are you, right? And then if you're the more toxic you are, the higher we charge you versus the other way. Could you kind of explain a bit on how you do that and how you judge that?
Yeah. So like let's think like the Citadel Robinhood example was good. Like let's think about like what does Citadel's relationship look like with Robinhood, right? Like Citadel's makes a market for Robinhood, provides liquidity. Robinhood sends order flow. That order flow's non-toxic, and that's why Citadel is willing to pay for that order flow. Right. The way like Citadel evaluates that is they know I know this order flow in aggregate is very non-toxic. I don't have to look at like every single order that's coming through and evaluate it. Like I have not guarantees, but like I'm pretty sure like if an order comes through Robinhood, it's non-toxic. So I don't have to worry too much about like, oh, is this some sort of like sharp flow or an HFT bot, because Robinhood doesn't let HFTs sign up. If Robinhood decided to break bad and say just run its own HFT desk inside Robinhood and send a bunch of sharp flow at cheap execution rates to Citadel, maybe they wouldn't turn them off that day. Maybe like you could send a few trades through, right? Like you could like before Citadel realized what's going on. Maybe you could even do it for a week, but eventually Citadel would look at the order flow and be like, well, like fuck you, right? Like we're going to terminate our relationship. So right, like it's a relationship that like when you have this aggregate relationship, it can be a lot more efficient than if you're looking at every single trade in isolation, and it can be rational for both players, even like because it's a repeated game, right? So it's not rational for a player to like try to maximize on every single thing. So we can do something similar with our vision of hooks, where you can look at a given participant, and crypto, there's all kinds of things. What does a given participant mean? It can mean like a smart order router. It could mean even just like an entire different protocol, like liquidations that are occurring from a lending protocol. It can mean like a relayer, because we have support for like off-chain signatures, and then a relayer can put them on chain. So it could be a relayer. So like, but right, like we have some notion of like this is an aggregate. This is a source of order flow in the aggregate, and that can be measured over some aggregate period, like weeks, months, whatever, and then you can say, well, how toxic is the flow from this aggregate? And given how toxic it is, right, you can start charging them less. Like same way Citadel will charge Robinhood less. And then if it does, starts behaving badly, right, you can look at the chain, like we can all agree on it. We're really excited about like co-processor, like technology that's being developed right now, and think like, this will make it really efficient, but right, you can look at it and say, hey, this is like really toxic flow. Like the reputation's bad. Like your score goes down, you're going to pay a lot more. And then to your point, the GIF or tipping, what we call it, right? Like you might say, okay, well, we have order flow, and maybe it even is toxic because we're going to have arbitrageurs, but ideally we want those arbitrageurs to send the value they're deriving to the liquidity providers instead of flash bots. So, right, like you can start saying, okay, in a given pool, there's rules around like you can send toxic flow, but like in aggregate, we want you to donate, say 90% of it back to the pool or something like that. And again, this is all on chain. It's very easy to measure over, not on a single trade because there's noise, but over a month, right? We can look at the aggregate statistical values and kind of all agree on these metrics.
Wow. So the way I'm kind of hearing that now is almost like, it's like almost pre-MEV. You do it at like the liquidity level. So you kind of take that away from all the snipers, and then you just effectively rearrange the blocks with the liquidity provider in mind, so that all the toxic flow goes first, but I got to pay for it, and you're going to get paid for it. And we kind of eliminate the MEV. It's like front running the front runners.
Yeah, and we can keep it fully composable because again, right, like anyone can interact with the pools without going through this facility or whatever. You're just gonna pay more, right? Like you're gonna pay, probably say 1% instead of 10 basis points. So that's really cool because everything is still fully composable. If you want to like completely, go outside anything like this, you still can.
Got it. And let me switch gears a little bit and ask Miyu a question here. And if I recall correctly, Dave said Miyu's in charge like the BD side of things. So like, what is your guys' plan of attack to attract projects to come to Ambient first and be the premier location for tokens to get listed, prior to like Uniswap or any other AMMs?
Yeah, that's a really good question. I guess we kind of have a few different fronts that we're attacking it. So, I mean, the first one that we kind of touched on before is the user experience. So, if you're telling your users to go and post up liquidity on Uniswap, it's kind of confusing, or any other venue really. So we're trying to really refine that workflow. So, if it's a new token, you can launch like full range liquidity, like a V2 style liquidity. And then over time in the same pool, that can transition to a more concentrated. You could start using limit orders and things like that. So kind of the life cycle of the token and the pool, we have a lot of benefits there. And then the other side, which I guess we also kind of touched on, is, with our hooks, it gives a lot of scope for developers to kind of build new systems. So, using things like, so we have JIT mitigation is one. So using our hooks, you can whitelist certain wallets or addresses to do the JIT mitigation. So instead of them siphoning the fees away from the LPs, you're doing it yourself, and then you can just redirect that to the LPs yourself. So that's just one example of how you can kind of, from a token or protocol point of view, use things like hooks to better the experience for your own users. Or you can whitelist and say, if you're staking tokens on our protocol, you get cheaper fees when you swap or things like that. So, and then, not having this business license, I think is another plus. So stuff like that, like we'd love to work with projects on that and kind of not gatekeep it with, these licenses and things like that. So that's kind of the main approach that we're taking.
Got it. Okay, Miyu, that was actually a great soundbite. I'd love to double click on that and polish it a little bit, because I think this could be a really good short as to like, why should a token or why should a project list with Ambient first before any other AMM?
Yeah, great. Sounds good.
Okay, just say that last bit about how, the JIT protection and how like you could redistribute that profit back to, say, the LPs.
Yeah, so using our hook system basically gives a lot of scope for developers and projects to set up their pools that help their users. So one example is redirecting JIT profits. So we have inbuilt JIT mitigations. If you own the pool, you can just whitelist certain addresses to do the JIT. But instead of just stealing away those fees from the normal passive LPs, you can redirect them to your LPs or your users or wherever you as a protocol see fit.
Also, I'm getting this, like Dave was saying earlier in the beginning of the pod, is like this Robin Hood vibe. Not the exchange, but more of like the lore of like, taking from the rich and like kind of redistributing it back to the common people,
Or at least just like leveling the playing field. I think that's what Ambient is all about.
Right.
Yeah.
And then
I think the kind of birthplace of AMMs was democratizing liquidity, and that's why a lot of us loved it, back in DeFi summer and meme coins and things like that. But I think over time, the LPs have just kind of got pushed out more and more, with things like JIT and RFQ and, VAMMs with like an order book and then an AMM backing it up. I think LPs are just getting kind of pushed out further and further, and it's making it less and less attractive. So we're really just trying to bring that back and make it a
return to tradition.
Again.
I mean, I don't think you're right. You can really have a decentralized financial system if there are 6 firms, right, that have to, right? You're completely dependent on like 6 firms. Like, how decentralized is that?
No, that's fair. And guys, like normally the LPers, I think the reason why they keep getting edged further and further out is they kind of get labeled as like mercenary LPs, right? You're just here to farm my token and then you're just gonna dump me. So why should I be nice to you? Like, do you guys have any plans around token emissions and any of those kind of Ponzi-nomics, tokenomics way to attract liquidity?
Can't officially comment on.
Cannot confirm nor deny.
Cannot confirm or deny any plans for that. But we've thought about that issue quite a bit, I'll say.
Got it. But if a project were to decide to use their own tokens to kind of advise,
so the way we kind of at least I think about it is I think liquidity mining incentives make a lot of sense. There's definitely a space for them, right? Because you're trying to solve for this like network problem where you need like liquidity to get users, but then you need especially non-organic flow for like liquidity to be sustainable. And you even see that like in TradFi to a certain extent, right? You have like market maker incentives when like stocks IPO, right? Like kind of the quid quo pro is like I pay an investment bank a bunch of fees, and like one of the things they're supposed to do is like help make the markets liquid in my new stock or whatever. So like it definitely makes sense, right? There are reasons why like you want to internally incentivize liquidity, and we've also kind of that's another thing, like we've with our hooks, like we've kind of leaving a lot of scope there. I think one problem with V3 is that like liquidity mining is just way harder to do than V2, and I think, right, like you kind of have seen less innovation because of that. So like we're trying to make liquidity mining definitely enough space there for innovation, and particularly around like concentrated liquidity and things. And I think it makes sense. The only thing I'd say is, right, like with liquidity mining or like token incentives, right, there is this kind of siren song where it just becomes like everything, right? Like there's no project. People are just there for token incentives. The project isn't really doing anything besides token incentives. So it's like a pure Ponzi game, like in the sense that there's like, so it's zero EV, right? Like, so someone has to lose. So yeah, I mean, right, it is tempting for projects to fall into that, but I think there's definitely a lot of scope for liquidity mining incentives, that especially those that are like intelligently designed, and you think about like, what am I using these for? Like, I'm not going to be able to emit these forever, right? Like you can't just inflate forever. So like, what do I, like, this is real spending capital. So like, what am I trying to get for the capital that I'm spending?
Right. And I actually wanted to double click into Ambient Finance's feature rich product. I was going through your guys' docs, and there's like surplus collateral and net settlements, gasless transactions, dynamic fee adjustments, and then knockout liquidity on top of all of that. You know, in the beginning of the pod, you mentioned things kept getting more and more complex. Yet you guys are still trying to keep it so that economically the LPs are kind of on an equal playing field. So I love that you're pushing the edge of complexity while keeping things as fair as possible for the common user. Could you share a little bit about why all these features come together and like the impact it can have on the AMM space?
Yeah, definitely. So yeah, like you said, it's always a tough trade-off between, like, it's easy to come up with a bunch of features, but you kind of have to stay focused on a single vision. So sometimes, right, like there's stuff that's not in the protocol that would maybe we liked, but it doesn't necessarily go towards the core vision. So I think with like all of those things that you listed and everything we have, right, like two core things that have always stood out is like, we want the user experience for the ordinary person to be as seamless and easy as possible. It shouldn't be harder than using a centralized exchange at the end of the day, or more boring than centralized. That's the other thing too, right? Like, you don't people like to trade, right? Trading's fun, right. So we want to keep it fun and engaging, and definitely our team has done some great work there, I think. And then the second thing is fixing the economics. So like, even like, right, like what we mentioned is around like what you've mentioned, like for example, dynamic fees. We've talked about that. The knockout orders, which are like limit orders, our version of limit orders, I think are really important because it brings a new type of liquidity provider. People want directional execution into the protocol, and that's really important because on boards like a whole class of people that exist in like the order book space up until now haven't really existed in the AMM space without kind of falling into the PvP games that traditional limit orders fall into. And then like stuff like gasless transactions, not only does that, once we incorporate that into the protocol, not only will it make it, I think, a lot more seamless because you're not, right, and Relayer can manage transactions for you, but you can use those gasless transactions to build, different types of pools where you can start. You can start, right, like you can have pools where you can use those gasless transactions, and then you can have like a sequencer layer outside the pool. So with our hooks, right, like maybe you have a hook where you want a pool where you have like kind of fast confirmation. So you have a sequencer, and only the sequencer can put in orders. And so instead of having to do like Ethereum orders and bundles and dealing with like block builders and everything, right? Like you can just do a single Ethereum transaction, put in the call data that corresponds to those gasless transactions, and then post those to the pool. So like kind of a lot of those things, like it's kind of been nice, right? Like things where the economics are better often turn out to be things where like the user experience is better. so far. Like when you really kind of think about the architecture and what you want out of it.
That's an interesting point. That last point you said. When the economics are better, the user experience is better.
Yeah, I don't know, I don't know if I exactly know why, but it just seems to be like stuff where you come up with something and you're like, oh, this makes it. I guess one core reason is just because, right, it's not just about keeping out toxic flow. It's also the more non-toxic flow, the better for liquidity providers. So that's a big reason why, like, want the product to be engaging, because the more ordinary people that trade, right, the more profitable it is for LPs.
Yeah, you mentioned how knockout liquidity, which is your version of limit orders / range orders, is different than standard limit orders, and it's going to bring a whole new class of participants to Ambient. Can we go into that a bit more? Like and how'd you come up with the name knockout liquidity?
I don't know. I'm not very good at naming things. To be honest, I always come up with names and then get better names. But yeah. So yeah, the reason they're called knockout orders is like what they really look like, or they're like traditional V3 range orders, but they live on a very kind of thin range. So like now it's 16 basis points, depending on like, the pool version, they could be thinner all the way down to 1 basis point. And what happens is when the price of the pool moves past the end of the range, the order, so they participate, they provide liquidity, the same as any other range order, but when it moves past the end of the range, they atomically get pulled out of the pool. So Uni in V4 has a similar, or it has like a hook, or they had like an example hook to do this, but the problem is it's not built into the core of the pool mechanism itself. So ours are built into the core pool. Every single pool has knockout orders enabled, whether it has hooks or not hooks, we think it's a lot simpler. We think it's kind of important enough that you want it on every single pool without kind of this inefficient call to an external hook to do it. So yeah, and then the way it works is once you move past once you move past the end of the range, it atomically gets filled. So even if the pool, so the problem with traditional limit order to do this is you can kind of do it, but you have to have like a keeper, you have to be watching it and like pull it out. For us, even if it happens in a flash, so say sandwich attack happens, it's the flash bots bundle, and the price like goes down 10% because Jared from Subway moved the price. If you had a limit order, if you had a knockout liquidity, you'd get filled right away and have that position atomically locked in. So if you put it like 10% below the current price, Jared from Subway comes in and does a sandwich attack. You've just locked in a big profit, right? Because you just filled like 10% lower than the price. So it's really cool from that perspective, and also like improves market quality a lot, particularly around sandwich attacks, because it makes sandwich attacks a lot more costly, right? Because now all the traditional problem with AMMs is all the liquidity on the way down is available on the way up. So it, to the extent they're used, it kind of dissuades sandwich attacks as well.
Just to add on to that, you're getting the liquidity provider fees for your limit order. So you essentially become a maker instead of a taker. So instead of, putting in a limit order through a keeper bot or some other system, you're still paying the swap fee. You actually earn the fees with ours. So
The tables have turned.
Yeah.
Oh, that's interesting. It's just like how, because right now the way I use Uni V3 sometimes I just put like literally the 1 tick band, and then once it kind of clears, I have to go in and pull it myself, right? Except now it's just
it should
automatically
be using
for me.
Ambient. Yeah, it's good for you.
yeah,
Oh,
it's exactly that. Yeah.
And then there's this one more thing that I saw. You guys have the ambient liquidity as well on all the fees earned. So it kind of auto compounds right away for you. Could you kind of explain a little bit about that?
Yeah, so the way like it works in V3, and I think it actually still works this way in V4 as well, is fees are just accumulated in the side pocket. So like you have a swap, it goes through, like it collects the fees. Someone pays the fees in some side, and then it just sits in the side pocket. And you have to kind of manually go in and harvest it because it's not earning anything. So when our AMM mechanism, we still collect those fees, but as soon as they're collected, they immediately get reinvested back into ambient liquidity or basically full range liquidity, and so your fees are still providing liquidity and therefore earning fees on top. So they don't earn it at the same concentrated rate, but the trade-off rate also, I guess, if you go out of range, you're still kind of earning a little bit of liquidity.
So your fees are earning fees.
Your fees are earning fees. Yeah. So I don't know. We think it's right. Like both useful increases liquidity in the market, and users. You don't want your capital sitting there.
Speaking of fees, something you mentioned earlier as well is your dynamic fee setup that you have. And I completely understand what you mean by this because at my previous job, I worked at Gelato and I worked on GUni. And I remember when we created the DAI USDC pool is originally 0.05. And that was the original one. And then they came out with 0.01. And then we had to like create a pool for that, and you had to like attract all the liquidity over to that pool. And in a previous interview, you actually described, with your dynamic fees as a kind of a price discovery vampire attack on uni pools. So can we go into dynamic fees a bit more? And don't you think on a long enough timescale though, like fees are just a race to the bottom, and eventually they'll just be like the lowest, fee rate possible?
Yeah. Let's see. So like our fee model. So we have different fee models depending on the pool, and again, these are our like canonical pools. And again, we'll be opening pools to open hooks. So like if you create a pool with your own hooks, you can put in your own dynamic fee system. So the innovation's kind of open there, but again, this is what we think is the right model for our primary pools right now. But the idea is, Uniswap's kind of this canary. The nice thing about it is because it has these fixed fees, it's always like this running experiment of at least 5 or 30 or 1 or 100, which fee tier is the best, and it's very easy to measure because it's on chain, and just say, okay, in the past 10 minutes, or past 30 minutes, past whatever, what pool has done the best? And so like, that's kind of a very cool thing. So yeah, that's why we call it a price discovery vampire attack, because I guess the uni LPs are kind of doing the hard work for us. Eventually, right, like with every token, it's not always going to have uni reference pools. So we do have a separate model that's based on like our internal pools and kind of uses this feedback loop to say like, what's the volatility in the pool and other things like that. And that's purely on chain as well. So that's like the cool part. That's the cool part there with dynamic fees. I think the underlying economics behind that is that kind of something I mentioned earlier. The price of liquidity at any given time shouldn't be the same. So when markets are very volatile, HFTs do the same thing, right? They widen spreads because there's a lot of demand for liquidity and there's not a lot of people supply. Inventories get filled up. People stop quoting. Central order books or even centralized exchanges will start. Liquidity gets thinner, so it makes sense. If you have an AMM pool, you should charge more for liquidity during the times when people are really willing to pay up for it. And then to your point, will fees go to zero? I don't think so, right? Because like even with HFTs where you don't have like tick size, like eventually, right? Like there's still a cost to the capital. There's still a cost to liquidity providers or like short convexity. I think there might be during some periods where fees get very, very low because there's not competition. But I think during periods of high volatility, when markets are really moving, there's just not going to be enough liquidity to fill demand. And so I think, particularly if you have a dynamic fee model, and HFTs work that way too. Like oftentimes you'll see an HFT will make hardly any money, and then like one day is almost your P&L for the year because there's like a flash crash or whatever. So honestly, I think that's the model.
Yeah, honestly, that's how you see Curve kind of work. Like Curve, the fees are like kind of flat, and then all of a sudden there's a day of a ton of volatility, and then boom, the fees just skyrocket. Which actually transitioned to my next question pretty well. Also in the news, we saw the Bank of International Settlements for Project Marina adopt Curve's AMM port to trade wrapped CBDCs on I think it's I'm not sure if it's AMM or VAMM or something, but it's basically using Curve's model. And so what that leads me to ask is like, what is your what is your reaction to institutional adoption of AMMs? And I know something you talked about in the past is you hope to see Microsoft futures traded on Ambient in the future.
Not just Microsoft futures, Microsoft stock.
Microsoft stock.
Yeah, but futures as well, though. Everything.
Yeah, it all. So does Ambient have like a plan to target institutions in the future?
Yeah. So, I mean, from one perspective, we're just trying to build the core protocol. I think other people may have more skills in terms of us and better relationships in terms of onboarding institutions. So we're trying to build a platform where, people can kind of build whatever vision of a liquidity pool that they want. So be honest, probably the biggest thing to onboard institutions right now is like KYC. A lot of institutions don't want to trade an AMM pool unless they know everyone else in the pool. So like that obviously can be done with hooks. Can argue, right, that's like against the spirit of crypto. We're neutral on that, right? People can build that or not build that, use it if they want. But in terms of, right, just onboarding institutions, I think like the first thing, it's not just institution. Like at the end of the day, Citadel doesn't want to trade with Jump 100 times a day, right? Like you still need organic users. So I think like a lot of people in this space get, if I bring an institution, then I'll be fine. But like a lot of times you need a mixture. Markets are an ecosystem. You need both. So I guess that would be like, first thing is let's fix the economics. And then I think if AMMs are clearly better than order books, which I believe they actually can be, right? Better than centralized. I believe actually you can get better execution. I think the economics are better because more people can participate in providing liquidity. And the reality is like HFTs have very, very high hurdle rates for return on capital. So like once AMMs actually are working, I think the reality is you can actually get better than NASDAQ. So I think if the economics are there, the players will come.
Okay. Wow. That actually, it got me thinking a little bit earlier in the conversation, Doug, that you had mentioned how Ambient would compete against kind of like all the other routers to get the order flow come to you. Could you kind of explain a little bit how a router works and how does competition in kind of like the router space works?
Yeah, for sure. So like a typical like order router will have some preset universe of liquidity sources. So if it's a Uniswap router, obviously they're just going to look at Uniswap. Or I think they just look at, I'm 90% sure they just look at Uniswap. If it's the MetaMask router, right, they'll be hooked into, a bunch of different liquidity sources, probably most likely Uniswap, but, there's other longer tail sources of liquidity. 1inch does the same thing, right? So like they're kind of abstracting away the liquidity from the order flow. Mm-hmm. And the idea is, right, they get the best price for the end user. So like being aggressive in that type of order flow makes a lot of sense because to the extent you think it's non-toxic. So there's like kind of different conditions, but like a lot of times, depending on the router, it's pretty non-toxic. So if you're connected to those routers, what you can even start doing as a pool is you can say, hey, I know this order flow is non-toxic. So not only can I like set my fee rate, but I can look at the price like relative to the other pool. Like the smart contract, I can say, okay, like to be able to win against Uniswap or like whatever these other things are on the router, I know that I can set, given the price of my pool and the fee, right, I can set my fee to here and I can probably win the order flow. And since it's non-toxic, like if it's non-toxic, like you almost want to take it at any fee rate as long as it's above zero. So we've been looking at that. So I guess like an order flow vampire attack, and we're kind of in the early stages of looking at that. But where we have order flow that we know is non-toxic, we can actually even directly look at the Uniswap prices and just always set the fee to be like, 1 basis point lower. So like the effective swap rate is 1 basis point lower.
Got it. And you guys have launched for almost like a month now, right? Or so, give or take, from DeFi Llama. It shows you guys started early June. Like, how has that played out in the actual, in production? Have you guys been beating out other routers or?
Yeah, it's a process to get on the routers. We have to get, like, it's all this chicken and egg problem, especially we don't have a token as of yet to incentivize liquidity. So right. I think we've been steadily growing liquidity for kind of our goals early on have been to always kind of validate, especially on the product side, validate product market fit, make sure people are understanding the product. We have some tweaks there, and now I think we're kind of ready to be pretty creative on the protocol and the economics side.
Any hints?
Mostly what we talked about, and again, can't talk about some of the whether we have a token or won't have a token or anything like that.
Of course.
I mean, I'm still hung up on the fact that he said the word yet. No token yet.
Cannot confirm nor deny.
If slash when.
Yes. So last question on my end is like, what are the keys to building a successful AMM, and what does success look like for Ambient?
Yeah. Miyu, actually, you have any thoughts on that?
I love to hear from both of you, but let's start with Miyu.
Yeah, I mean, that's a really interesting question. I guess it's such a nascent space still, it's only a few years old. So there's kind of a lot to figure out, but I guess what our focus is and the way we're thinking about it is obviously the economics behind, Alpine and the kind of general market state, but then I guess more specifically, I think our focus on the end user and the product is going to be a big driver for us. So I think it's fairly clear from the web app that we're putting a lot of effort into that to try and make everyone's life easier, do a lot of tools to help that. So I think that's kind of the two-pronged approach that we're basically taking to kind of set ourselves up for success.
Got it. A better product and a better experience. And then Miyu, what does success look like for Ambient? Is that like a TVL number? Is that a volume number? Is that like you are the best router in the game?
I mean, we kind of don't think that TVL is a great metric, and I think most people kind of agree with that. So TVL is probably not the metric. I mean, it's a start for how to measure success, but we kind of think of it more as, stuff like at-tick liquidity and things like that. So, but I think the ultimate success would probably be the place for price discovery. I think that's kind of, if we get to that point, that's kind of when we can say it's a success, I guess.
How do you know if you get to that point?
Achievement unlocked.
I mean, right, probably the simplest way is volume is also, like you asked about that, volume's also a gameable metric, right? Like you can have a USDC DAI pool with 0 bips and you're going to have a lot of volume, and that's great.
Yep.
Yeah, I'd say, right, like it's almost like you kind of know it when you see it. If you ask people now, where's price discovery in any market, crypto, anything, where does price discovery happen? I think most everyone agrees with it, but I think probably the biggest thing is you're the default destination for trades. So, if somebody's going to fire off a trade and it's going to you most of the time, then you probably where price discovery is happening.
Got it. Ambient versus Binance. That's another way of saying that.
Ambient versus the world.
Ambient versus NASDAQ, right?
Ambient versus NASDAQ.
Yeah.
Ooh, that's for aim higher.
Yeah.
And Doug, I guess
David versus Goliath.
Yeah. Doug, if you can kind of end the pod here with like a high note, is like, what does success look like for you?
For me personally.
Yeah, with Ambient, because coming from your background, that's like, being literally in the trenches.
I'd say the biggest thing I would say successful, like I think I mentioned earlier, a lot of TradFi, especially HFT people, are skeptical of AMMs. I think if we can build something where people start really sweating, at least in terms of people start talking about AMMs as like not just like an on-chain thing, but like as the actual like future of market microstructure in general, then I'd say that would make me really happy.
Nice. Well, on that note, we're going to close out the interview. But before we go, before the end of every interview, we like to do a little lightning round just to get to know you guys a little bit more and on a lighter note. And yeah, Kit, go ahead.
Yeah. Yeah, this is just to kind of get to know you as the man, the person behind the builder.
The cat girl.
Exactly. The individual behind the PFP. So let's start with Miyu for this one and just come right, the first answer that comes to your mind. What was your virgin crypto experience? When did you first touch the blockchain? And sexes doesn't count.
It would have been late 2020. Yeah.
What did you do?
Using Ethereum. I think I sent some USDC from a centralized exchange and then bought Ethereum on chain.
Nice.
Yeah.
Nice. Doug, how about you?
Probably a similar story. It would probably be back in before I did crypto full time. Like I think 2016. I think the first time I was actually sending a Litecoin between two exchange. I think from Coinbase to Binance, I was sending Litecoin. Bitcoin was too slow. So
that's fair. That's fair.
Yeah.
Okay. The second question is, what is your favorite off-chain touch grass activity? What are some of your hobbies and interests? Let's start with Doug here.
I have two young kids, so it's mostly if I do have free time from AFK, mostly try to spend it playing with my kids.
Solid. Miyu?
Yeah, I've been playing guitar a lot again lately, so that's kind of been my main go-to, I guess.
Nice.
Cool.
I'll take the next one. Miyu, what would be some advice you would have for your younger self?
Just start.
Just start.
Just do
just
things.
Send it.
Yeah.
Just do things.
Yeah. Just do things. Stop waiting. There's never a perfect moment, I guess. You just gotta go.
And Doug, to you?
I'd say probably more skate to where the puck's at, and kind of a big reason I'm in crypto now. It's not the biggest market in the world yet, but I think it's probably the future. So I think a lot of people will go for whatever the biggest or most prestigious thing is, instead of I'd focus on things. What's this world gonna look like in 10 years? So what do you want to be working on today for that?
Skate to where the puck is going.
Good advice. And the question on my end is, if you weren't in crypto nor in finance, what would your professional career be? Let's start with Doug here.
Yeah, I love software, so I'm definitely some sort of tech thing. I just really like software, really like coding, so it definitely would be something in the tech space. I don't know what. Probably SaaS, to be honest. I would hope something more interesting, but probably SaaS, B2B SaaS.
Got it. All right, Miyu?
I mean, I probably would be doing my design background, architecture, landscape architecture, but I've really kind of fallen in love with, web design and product design side. So if I wasn't doing this, I'd probably be doing product design or something like that.
Yeah, me would be at my B2B SaaS would be selling enterprise software.
What a timeline. And final question, Miyu, who do you think should be the next guest on Flywheel? Who would you recommend?
Oh, that's a tough one. There's so many good accounts.
I know. One person.
The first one that comes to mind is Emily, actually.
From eGirl.
From eGirl, yeah, and Alchemia. I think she's a great person. So, and she actually, fun fact, she put Doug and I in contact with each other initially.
Yeah. Oh wow!
So,
yeah,
I'm a big fan.
Doug,
Okay.
to you, who do you recommend coming on the Flywheel?
I would, so I'd say balance out my pro AMM propaganda. I don't know if you guys know DeFi guy or OX Shit Trader is his Twitter handle, but he's building a new cloud protocol, Ellipsis, on Solana, and he can speak very intelligently and maybe would give a kind of a balanced perspective.
Interesting. Good choices all around. And on that note, guys, Doug, Miyu, thank you so much for coming on. We got deep in the AMM, deep in like liquidity, and thanks for coming on. And we hope to see you guys again soon. Awesome.
Well, had a fantastic time. Thanks for having us.
Yeah, thanks, guys. This was a great chat.
Thank you.
Thanks, boys.
GM, everyone, thanks for tuning in to this episode of Flywheel. We had on the Ambient fellas, and now it's time for the post game. And so thank you for joining us. We went deep into everything ambient, everything about AMMs, Doug's prior history, high frequency trading. We really covered a lot of bases in this episode. Kit, what was your favorite part?
Oh man, let me just take a second and shake it out, because I felt like I used so much of my brain power just trying to understand the kind of the mechanics of Ambient, and also their battle and war against toxic flow.
Yeah,
I think my favorite part was what Doug brought to the table, and obviously what Miyu brings to the table as well too.
Oh, absolutely. I think my favorite part was when hearing them and hearing how. But what kind of perspective they've built Ambient from, and just immediately clicks with me like, oh, these guys are the Robin Hood of DeFi. They're trying to, represent the common man, the everyman, allowing them to, either participating in LPs and just ultimately leveling the playing field. And I think that's what Ambient is all about. And it's just really refreshing to see, especially when you see this turn towards like business licenses and towards like quote unquote institutions and like more privileged actors, quote unquote. With Ambient, they're like, hey, we're trying to help the little guy. And at the end of the day, better economics equals a better trading experience, an LP experience overall. And I think that's a very positive flywheel that is often overlooked.
100%. I think they are, for lack of a better term, making LP great again. There was a big issue.
That's what I thought. Make LP great again.
Make LP great again. And I think they're going to come in and do it right. Like if you looked at their documentation, like their feature set is so fat, like pH fat, and it's all under the hood.
pH fat.
It abstracts away from the complexity for the user while still giving the user all the benefits. Like you said, better economics leads to better product experience. It's just kind of like a guiding light that they have. And I love this underdog energy. You know what I mean?
Oh, yeah, absolutely. And, they just launched, and I'm excited to see, them grow and how they're evolving in the future. I found it interesting that, they announced in 2021, and they basically didn't even release their V1 at all. They waited until their V2 and to release their first product. What are your thoughts on that? Do you think they would have been better off if they released their V1?
I seeing the innovations that they have done, I think it may have been worth it for them to wait it out and like to see all of the flaws of all the other systems and then implement like an improvement. I'm normally in the camp of like, I'm sure you are too, is just ship it and let the market tell you what's wrong with it and then improve in production. I'm more in that camp, but I think in their case, since they're trying to go after that true primitive again, they're kind of redefining what a quote unquote AMM should provide on the base level, just like how Infinity Pools was. You know what I mean?
Exactly. Yeah. I thought there's so many different parts we go into. What did you think of Doug's background previously in high frequency trading and at Citadel? So he was on like the other side before. And now he's, now he's playing this Robin Hood role.
Yeah, I liked. I wasn't sure if it was off camera or it was in the recording, but how like success for him was like, it wasn't. But how success for him personally was when all the folks that pretty much denounced AMM or just denounced crypto as a whole, and that he's really has this driven motivation to prove them wrong and show them that like no, like this is where the puck is going, like. I like that about his background. Like you can kind of tell that he's making a bet on crypto, and then coming from his experience, he's bringing all of that learning to the table. But how about you,
Yeah.
Dave? What do you think about him working on the dark side, as you said?
I think that's how he got all his experience and like seeing firsthand how these, market makers and operators operate, gave him kind of the foundation to build, Ambient today.
I agree. He kind of gave me like a little rebel vibe too,
Oh, 100%. Yeah.
Yeah, like he's definitely like a rebel.
I have a good question for you. What do you think Ambient can work on, and like what risk do you think they should watch out for?
Great question. I think at the end of the day, it is about capital L liquidity, and can they retain it? And well, first, can they attract it, and then second, can they retain it? Because the reason why Uniswap becomes like the de facto place is frankly because there's just a ton of liquidity, and that liquidity
and
is
a ton of loyal
kind
LPs.
A ton of
Doug
loyal
mentioned
LPs. Exactly.
Doug mentioned in
exactly.
the previous interview.
Yeah, a ton of loyal LPs who are kind of used to getting beaten on, right? Like they're kind of used to get jitted. They're used to getting slapped in the face with all the ILs. So like, how do you kind of convince this base to kind of migrate over to you? Or how do you even develop a new base completely? A lot of education is going to be required. So I think doing more of these kind of pods, or, getting their solutions and product features out there, I think it is a huge challenge for them, because it's really feature rich. If you don't read the docs, if you don't watch the pods, like you're not going to kind of get it. And
I can.
A good example, like Dave, I'll show you. In the UI, if you click on one of the candles, it'll show you the transaction that's in that candle. And I'm like, why is that not advertised? And why is that not standard across Dex Screener or any of these other websites in which you kind of like, track and use the candles? Like, it's so obvious that it kind of should be. But yeah, how about you, Dave? What do you think are their biggest risks, and what do you advise them to kind of work on?
Well, they have all the tech and they're doing innovative stuff, but I think their biggest challenge is on the BD side and being able to attract projects and be like, hey, like come here. You guys should, first supply liquidity for your project here, because it's so vital, because 80% of all volume for a token happens within, a week or like a month of listing. Like most of the volume will happen at that time. So it's key. It's absolutely key for any AMM to get be the first go-to. So that's why it's so interesting seeing Uniswap V2, still around, and you still, you had Pepe and all the meme coins listed on Uni V2 because it has that brand name and it's easy. So I think the biggest challenge for them coming up is being able to do the BD and be like, hey, come here, you should list here. And Sushi had pretty good BD in 2021 because they had their token incentives and everybody was listing on there. Uniswap, they still had the V2 mechanics and everything, but now Uni V2 is still a go-to and whatnot. So I would say BD. Right.
And also, you brought up a good point with Sushi about remember Sushi had I forgot what it was called. Is it called Miso Launchpad or something like that?
Oh, they had the Launchpad. Yeah.
So they also had an actual launch product. We didn't get to ask about that because when we asked Miyu, he was basically saying how our product is the best and it will shine through. And I don't know if I fully subscribe to that. I think you might need to do a little bit more hand holding. Yeah.
Yeah, I mean, there's a reason VHS beat out Betamax.
Right. And arguably the worst product, right? So.
Yeah. Oh, and I have one more question for you, or one more point. So in the interview, at one point, I heard the term cost of capital thrown out there, and I immediately was flashed back to our interview with Chidao and, Benjamin talking about cost of capital. Yeah, cost of capital. And it had me thinking about capital in another way, especially with their dynamic fees. And basically, the more volume there is, the dynamic fee increases and the cost of capital goes up. And if the volume goes down, then basically the cost of capital goes down. So what are your thoughts on, how they think about cost of capital?
I think that is very well. The way they're kind of saying it is slightly different. It's the dynamic fees is to offset the amount of toxic order flow to you, right?
Yeah.
If you see, so I think it's really clever because remember, I think this was off camera, but Doug described how a router works, and they effectively prioritize a couple parameters from price to fees to gas costs. and kind of frankly net it out into a single number, and whichever router gives the best number there would win the order flow. But if you know this order flow is toxic, then you kind of don't even want to bid on it, right?
Exactly.
You don't even want to be included. But
it's
if this
toxic,
order flow, so if you do, if you kind of have to include it, you're like, well, I want to get paid more for taking this toxic order flow, so I'm going to increase my fees. Like, that's what he meant by the dynamic fee adjustment. And an example of that was during periods of high volatility, like during the Circle and USDC DPEG. During that time, if you were to be an LP, you should be charging like 1% spreads, right? Or even more, so that you know that people are going to come and whack you. Yeah. So I think that is very interesting, and how they're doing it for you dynamically without. I mean, I would imagine the LP doesn't need to do anything, right? They'll just be like, yes, please automatically adjust my fees for me. I want to get paid more. I think that is absolutely critical, and then it would make me, as an LP, my cost of capital would effectively, go down because I'm getting paid just for my idle capital. So for when I do trades elsewhere, like my cost of capital now effectively kind of goes down because I'm getting paid on this other idle capital that I'm working on. So I think that was a really cool thing. But Dave, actually, I got a question for you. It's like, how did you feel about like when they first started, CrocSwap in their V1? They didn't even launch it, and they only launched their V2, and they waited to learn from the failures of Uni, learns from the failure of Curve. Like, do you feel that is the right way to launch a product?
I don't know if I would say usually no, but I think in their case, yes. I think it was actually a very smart and strategic move not to launch their V1, because one, like your V1 is like your V1. There's going to be a ton of things to improve on. And two, you kind of saw, like at the time they announced, you saw like a huge wave of AMMs, whether it was SushiSwap, gaining a bunch of ground, whether it was like forks on other chains, like PancakeSwap, QuickSwap. If they entered at that time, they would have been in a really crowded field, and it would have been a lot harder to attract liquidity. But now, you saw a lot of experiments played out. A lot of these AMMs are 90% down in volume and in TVL, and right now, especially in like the middle of the bear, quote unquote, it's actually the perfect time to like come out with some innovation and to come out with their deck. So like learn, just sitting, waiting, learning, observing, taking in everything, and then launching when the time is right, which I think is now. And now they're ready. Now they're just sitting in the water, ready to catch the next wave when a whole new host of participants come in. And if I'm like an everyday trader or a retail trader, and this is the exchange, that's the Robinhood exchange that is like fighting for you, like I am like, would be more predisposed to like go trade on Ambient. And so like, I think like that's why, because they're about to like catch the wave of the new participants. And they really, I think if they get their marketing and messaging correct, it'll just be a positive flywheel in that.
Right. The ethos of Robinhood, not the Robinhood exchange that sells your order flow to Citadel.
Yes.
Not that one.
not that one. I'm really excited to see what they're doing, and we'll definitely keep an eye on them. And if you want to keep up with everything we're doing here at Flywheel, make sure you hit that bell button, subscribe, leave us a like, let us know what you think of this one in the comments. Love it or hate it, we want you to hear from you. Make sure you follow us on Twitter at Flywheel DeFi. Join the conversation on Telegram at Flywheel DeFi. You can follow me on Twitter at DeFiDave22.
You can follow me as 0xcapital_K.
Subscribe to our Substack, flywheeldefi.com, and we'll see you next week. Peace. Everything said on this episode is not financial or tax advice. This channel is strictly for educational purposes and is not an investment advice or solicitation to buy or sell any assets or to make any financial decisions. This video is not tax advice whatsoever. Please talk to your accountant and do your own research.